Hi, welcome to an introduction of the accounting process. The accounting process is fundamental to accounting. We're going to take your education way beyond the accounting process, even by the end of this class. But this process is at the heart of all of the information, much of the information that is produced by the accounting department. So we must very accomplish great mastery of the accounting process, even though in reality, for companies of any size, much of this is now automated. Okay, so as we begin our discussion of the accounting process, there's the learning objectives, and I think that you're probably by now pretty used to them. So I will move on and talk about, economic events. An economic event is any event that directly affects the financial position of the company. They can be external or internal. Financial statements really are a summary of the thousands and millions of economic events that occur every period in a company. An external economic event is an exchange between the company and a separate entity. Examples of external economic events include purchasing inventory, borrowing cash from a bank, paying salaries to employees, and literally a million other potential economic events. Internal economic events are events that directly affect the financial position of the company, but do not involve an exchange transaction with an outside entity. Some examples of internal economic events include depreciation of equipment, the use of supplies that we bought earlier. These events must also be reflected in the financial statements because they impact the financial position of the company, even though they did not involve at this time a exchange transaction with an outside entity. Let's introduce the accounting equation. The accounting equation is assets equal liabilities plus shareholders' equity. The assets of the company are what we have. The liabilities of the company are claims on those assets, things we owe. Shareholders' equity is the residual. If we have it, we either owe somebody else for it or we own it. The shareholders' equity amount reflects that residual ownership of our total assets. The types of accounts. Again, asset accounts, those are the company's resources, things we have, things we own, things we have. Liabilities are creditor claims on those companies' resources. Shareholders' equity is the owner's claims on the company's resources, that residual claim on the company's resources. And the shareholders' equity, we divide those accounts into two types. Shareholder equity amounts and accounts representing amounts that were contributed capital by owners, and shareholder equity amounts and accounts that represent earned capital. The earned capital is the sum of all net income in the past that we have not yet paid, returned to shareholders in the form of either dividends or repurchased shares. You'll learn all about those transactions soon in your accounting education. Accounts can be described as permanent or temporary. Permanent accounts means that their balance goes on and on and on and on. Temporary accounts are returned to zero at the end of every accounting period. The permanent accounts are assets, liabilities, and shareholders' equity. Permanent accounts are what make up the accounting equation. Assets equal liabilities plus shareholders' equity. Those are the permanent accounts. The temporary accounts are accounts that, again, will be returned to zero at the end of every accounting period. They're used temporarily to add up total revenues, to add up our expenses and our gains and losses and any dividends paid. So temporary accounts capture the change in the earned capital account for the year. Again, there's temporary revenue accounts, several temporary expense accounts, gains accounts, losses accounts, and dividends accounts. Those are all temporary accounts that will be closed to retained earnings. Now, you'll learn a lot more about revenues versus gains and expenses versus losses, but I'll introduce the concept here. Revenues are amounts we earned in our ordinary course of business. They're related to inflows of wealth that we earned by doing what it is our company does. If we're a shoe store, that's the sales of the shoes. Similarly, expenses are all the expenses necessary to earn the revenues in our main course of business. So the expenses are the cost we paid to buy the shoes we sold, paying the employees, paying other expenses. Revenues and expenses as opposed to gains and losses. Gains are inflows of wealth for sure, but they're not related to that main business of the company. There's some ancillary activity that led to a good gain. Similarly, losses are losses of wealth for the company, but again, they're not losses like we sold something for less than we paid to acquire it. They are ancillary losses related maybe to sales of investments of other companies. You'll learn a lot more about gains and losses as opposed to revenues and expenses over your accounting courses. Dividends are past earnings that we are returning to our shareholders. All of these temporary accounts are closed to the retained earnings account, the earned capital account, at the end of each year or at the end of every accounting period. We're going to talk about years but also we close the books at the end of every month and at the end of every quarter, as well as at the end of every year. The accounting cycle. Okay, so the accounting cycle refers to what we do every accounting period. During the accounting period, the accounting department obtains information about external transactions from source documents, things like sales invoices, expense documents like invoices that were being charged for our expenses. We analyze these transactions. We then record the transaction in the general journal. The general journal is a chronological listing of all the transactions of the business, all of the economic events of the business. Right after we have recorded a transaction in the general journal, we immediately post the general journal entry to the general ledger. The general ledger is a listing of all of the transactions and economic events of the company by the affected accounts. You're going to see examples of these in the next video. what you're going to soon learn is that now in 2024, we have technologies where as soon as we record a transaction in the general journal, if we're using accounting software, it'll immediately automatically post to the general ledger. But we need to know we need to learn up front what those solutions, what those technologies are doing for the company, given that we're going to manage the process. At the end of each accounting period, we are first going to prepare an unadjusted trial balance. That involves taking all of those balances from those general ledger accounts and putting them on an Excel spreadsheet and making sure that they do indeed balance, that assets equal liabilities plus shareholders' equity, debits equal credits. You'll learn what all of those terms mean if they're not very familiar to you yet at this point. After we've prepared an adjusted trial balance and verified that indeed debits equal credits from all of our many transactions during the period, we will record adjusting journal entries and post those to the general ledger. Adjusting journal entries correct accounts that have experienced balance changes due simply to the passage of time. Adjusting journal entries are also used to correct any errors that are noted, that were made. Correct accounts that have experienced balance changes due to the passage of time. What does that mean? Well, what that means is that some economic events occur, but we don't get an invoice for them. We don't have a sales transaction, but they are economic events nevertheless. An example is interest accruing on a loan. Interest accrues every day on the loan, but we don't record it every day. We simply bring the interest payable accrual to its appropriate amount before we prepare financial statements or otherwise report the financial position of the company externally. After recording all necessary adjusting journal entries and posting them to the general ledger, we prepare an adjusted trial balance. This is, again, just a couple of columns that ensure that indeed debits equal credits and assets equal liabilities plus shareholders' equity. We then prepare financial statements from the adjusted trial balance. At the end of every accounting year, we close the temporary accounts to retain earnings via closing entries, and we prepare a post-closing trial balance. Again, just ensuring that assets equal liabilities plus shareholders' equity. As we learn the accounting cycle, we're going to do two things together. We're going to use the spreadsheet method on a very simple case, but then we're also going to develop an accounting system, a debit-credit-based accounting system. And you'll see how both are accomplishing the same end goal. All right. So if any of that introductory discussion is new to you, please replay my discussion. Replay the video, that part of the video. Absolutely return to your textbook and read the chapter again. Read that upfront part of the chapter again. Really important concepts for you. In the next video, we will study transaction analysis. That's what we do every time an economic event occurs and we get a source document that about that economic event. We record it in the General Journal and post it to the General Ledger. So I look forward to speaking with you in that video, and thank you for your attention to this video.